All right, guys, welcome to this week's live lesson. Now, in this lesson, I'm going to talk about algorithmic price delivery and how we can interpret and gauge order flow from an algorithmic perspective. Now, I know there are a lot of new people here in this community, so I'm going to keep this simple as I can. Obviously, all of these concepts are expounded upon in Module 1 of the Market Maker Academy. Now, the algorithm has two main roles. It will reprice to areas of liquidity, or it will rebalance areas of inefficiency. Now, I explain those in great detail in Module 1, so I'm not going to go over specifically what they are. But what I do want to do is show you how just those two concepts can completely change the way you look at the charts. For example, here we have the euro dollar, and this is on the 1 hour time frame. We can see above these highs, what is this? That's right, these are relative equal highs. And what's resting above these highs? Buy side liquidity, right? But what specifically? Right, buy stops. And what's the other one? Yeah, stop orders, right? So when retail are going short here and they want to go lower, they're placing their stops above these highs. These highs in retail books are referred to as double tops, and these are supposed to be strong areas of resistance. So when a double top forms and price runs away here, retail are excited. All that's happening here is the algorithm is engineering buy-side liquidity above these relative equal highs, because of course the institutions wrote the books and they own the algorithm, right? So they will manipulate price lower. Why will they manipulate it lower? Well, because we have these relative equal lows down here. And what's going to rest below those relative equal lows? Sell side liquidity, right? So price travels lower. It dips into the pool of sell side liquidity. And what else can you see to the left here? We have this inefficiency in the form of this buy-side imbalance. So now we have an area where price is inefficient, and we have an area where we have liquidity that are both resting in close proximity. Since the algorithm is being created to be efficient, it will reprice to areas where there are both parameters in close proximity, liquidity and inefficient price action. I often refer to this as an area where the algorithm will kill two birds with one stone. Price has dipped into that sell side liquidity. At this stage, smart money are coming in here and they're piling buy orders, using that liquidity and then offsetting those positions to where? Where are the willing buyers in the marketplace? Well, we want to, if we're buying down here, we want to sell to the willing buyers. And the willing buyers are resting up here in the form of buy stops and stop loss orders. So smart money will buy from the sellers down here, and they will sell back to the buyers above the relative equal highs. Not only that, they will use that liquidity pool to also place sell orders of their own, pairing those short positions with that retail buy-side liquidity. Price then drops lower and it stays in a holding pattern here. Again, engineering liquidity below the market. And then we see this break lower and it closes back below the inefficiency. Once this happens, it gives us a green light that the market is now in a hurry to move lower, but not before it will run higher to do what? You see this inefficiency over here? Well, we've only got this sell side imbalance. The algorithm will reprice higher. Look at the body of the candles here. They're stopping dead at the consequent encroachment or the midpoint of that gap shaded here in that purpley color. And then what do we see occur? We have this huge displacement to the downside. Can anybody tell me what type of high this is? That's right, this is an intermediate term high because we have rebalanced this inefficiency. Is price likely to return to this intermediate term high if we are bearish? No, right? Now let's take a look at what happens. We have this huge drop lower, leaving all of this inefficient area of price. Now, when we have a large inefficiency like this, what do? We grade the entire range like so, right? So we have the different quadrants that we place on our sell side imbalance. Let me just make this a little bit thinner there, right? So the green line here represents the midpoint of the gap. We can see how price, after turning around over here, has eaten into that fair value gap and then dropped lower. Now look what it's created here. Can you see? We have these relative equal lows. So this would be a double bottom for retail. So what are retail going to do when they see this double bottom? That's right, they're going to think it's resistance, right? So where are they going to place their stops? The same thing that was happening up here is going to happen down here. Retail are placing their sell stops or their stop orders beneath these equal lows. The algorithm is engineering sell side liquidity here. Then what happens? Price turns around and runs higher. Notice what it leaves over here. Again, relative equal highs, right? With this high being lower than this high. What is this? That's right, that's a low resistance liquidity run signature. You guys have been paying attention. It's good to see. So we then see the market drop lower again. And it's working the discount end of that sell side imbalance. So inside of this lower quadrant, right, you can see all of this consolidation. Notice, again, that we're leaving these relative equal lows. So again, another pool of sell side liquidity rests below these lows. And then price continues higher. What's it leaving as it does this? Trend line, that's right. And what do retail think about trend lines? They think it's diagonal support and resistance, right? So again, they're placing their stop loss below this trend line. And all the algorithm is doing here is manipulating human behavior to go long in the market. Now, the algorithm is reaching for these relative equal highs over here. Again, there's going to be a pool of buy-side liquidity resting above those highs. If we look left, we have this short-term swing high, we have this low, and we have this higher high, right? So this down close candle, I'm looking at this as a breaker. Let me change the color of, that wasn't changing the color at all. Right, so we have this down close candle as a breaker. Note how we touch that breaker there. So we dip above the relative equal highs, engaging that buy side liquidity and into an area of mitigation in the form of this breaker block. Notice where price is closing. It's closing below the upper quadrant of that sell side imbalance. And now we have an area where we have two nested arrays. We have the breaker and we have this sell side imbalance. Price doesn't need to return all the way back to these two up close candles, which is what? It's a bearish order block, right? We also have these consecutive up close candles over here, but that's for another time. Now you can see the convergence of two PD arrays overlapping here. Buy side liquidity has been engaged and smart money are now piling in with short orders that are being paired with that buy side liquidity. Where is it now likely to reprice to? If they're selling over here, they need to cover their shorts by offloading those positions to willing sellers. Now, where are the willing sellers going to be? Well, where are the sell stops? Below the trend line and below these relative equal lows over here. So what happens? Notice how price has moved higher slowly, gradually in steps, because its job is to engineer all of that sell side liquidity. And then when time, look at the time, 7 o'clock, this is New York session, and price, where we have nested arrays, when these align, look at the movement that we get straight after that. on the 8 o'clock candle where we have news coming in. Price sharply drops lower, raiding the sell side liquidity below the trend line and the equal lows down here. Look at the bodies here stopping dead at the discount low of the fair value gap. Then what happens? Let me just get rid of all of this. Price travels higher. It retraces back inside of the range from this high down to this low. What is this? That's right, it's a dealing range. This dealing range has swept both buy side and sell side liquidity. If the market is bearish, we want to see the market move higher first before it goes lower. So where do we want to see the market reprice to? That's right, we want to see it reprice to a premium. So if we run our fib from this high down to this low, the midpoint is this green line. Anything above that green line is what? Let me just make that a bit thicker so it stands out. Anything above that green line is a premium, right? We want to sell short inside of a premium. Now, let me take this off. What else can you notice here? We have this high, low, and this higher high. So these two down close candles, what are they? That's right, that's a breaker. Same thing that we've seen over here, the same thing's occurring over here. Notice the bodies of the candles here are failing to close above the mean threshold of that breaker. We also have that breaker that overlaps with this sell side imbalance. Now you can probably see already that this black line is a consequent encroachment, the midpoint of this sell side imbalance. We nail the midpoint, the consequent encroachment, and then price rolls over and drops lower. Again, it leaves another low at the relative equal lows. Again, retail here are thinking that price is going to move higher once we have this move away. But where's it repricing to? The inefficiency from this high, from this candle's low, to this high, consequent encroachment. Again, note the bodies. We're failing to completely rebalance this inefficiency. What does that mean? Anyone? That's right, yeah. It means price is weak, right? So then what happens? It turns around and it runs for the sell side liquidity below these relative equal lows. Now, inside of this price action, where would have been the best entry? We have two entries, two real entries. One, let me just get rid of this. We have one entry over here. This would be a very nice entry. This is our unicorn model that, again, we explain in Module 1 of the Market Maker Academy. I also go into a lot more detail here in Module 2, but the best entry would have been over here. So above these equal highs, this would be a real turtle soup entry. This is how you determine turtle soups, right? It's based on liquidity, inefficiencies, and nested arrays where time and price align. The added fact that we have the upper quadrant of the fair value gap and prices closing below that is again another nice little indication that we have price here that is heavy and is likely to reprice lower to sell side liquidity and inefficiencies below the market. Now, any mentor who is teaching you should be able to catch this, right? So in our Discord group, under the win section, I said partials taken, stop to break even, left a runner to see if we want to drop towards the relative equal lows below, right? So I added this in the Discord group, and this was on the 30th of December. This is what it looked like, right? So I placed a limit order above the relative equal highs. I took 80% of my positions off at this blue line over here, and then I rolled my stop to break even and left a runner on. This is what it looked like when I zoomed out, right? So we had the relative equal lows down here that I was referring to. And notice that I didn't put my stop at exactly the relative equal lows. I like to get my positions out before we actually run the lows, right? So basically I was getting out below the bodies over here. And again, this is something that I've discussed previously. And you can clearly see how that's exactly what unfolded. I could have pyramided this and added another position here if I wanted to, but I did unfortunately miss this move. However, I capitalized and made a really nice run here. Where would I have placed my stop? Well, my entry was just above the high of this candle. It was on the upper quadrant of that sell side imbalance. And I would have placed my stop above this candle's high. Why? Because we have the order block. We have the sell side imbalance remaining here, which is a SIBI, and we have the balanced price range. So we have buy side delivery here and sell side delivery through that range. So in my opinion, price doesn't need to go this high. If it gets back above this high, then I am wrong. Now I have to assess how much wiggle room do I have, right? Is this going to be worth a trade? I at least want to aim for a 1-to-1, right? That's like the minimum, which would be roughly over here. But I can see that these relative equal lows is where price is likely to reprice to. So that would be my first target. And this gives me a risk to reward of 1.58. So I took off 80% of my positions over here, and then I left a runner to reach for these relative equal lows down here, which gives me a risk to reward of 2.5. Of course, I know I took off most of my positions here. However, this is how you can capitalize on price movements once you understand algorithmic price delivery and the order flow of price from an algorithmic perspective. The algorithm is going to refer to these levels, is going to rebalance inefficiencies, and is going to raid liquidity pools. When time and price align, that's when we want to pull the trigger. We always want to wait for price to engage with buy-side liquidity before we enter short, and we always want to wait for sell-side liquidity to be engaged before we enter long. And then we want to offload those positions to opposing liquidity pools. Right? So I hope this one has helped. I'm going to jump onto the other screen in a minute and we'll go through the questions. I know that you guys have had a lot of questions this week, and I'm going to run through those in a minute. But everything that I just explained here, you've all been taught this in Module 1. Yes, we go into a lot more detail, but once you understand the basics, once you understand the foundation of algorithmic price delivery, once you understand why price is going to reprice to certain levels and how to interpret algorithmic order flow, it's much, much easier for you to read price action.